Hello, everyone. My name is Brian Causey. I will be your speaker for the day. Just a brief overview. That's all we're going to do today. We're going to touch upon what is a non-grantor irrevocable trust. We're going to talk about our flagship product involving premium finance, talk about corporate sales, business sales, and how to fund each one of these. Now, a lot of companies out there are using these type of documents. You'll see here, you'll recognize most of them: Fortune, Netflix, Amazon, Chevron. All of them use documents. And you've been hearing a lot of information from Congress, a lot of information news. These companies don't pay any taxes, just like Jeff Bezos last year, the second richest man in the world. He didn't pay any taxes last year. There's a way to get around it, a legal way, and we're going to talk a little about it. It's going to be briefly. Okay, first thing we're going to talk about is a non-grantor, irrevocable, complex spendthrift trust. It's a mouthful, isn't it? Well, the title sort of describes the trust and its functions. It's a complex trust, indicates a tax designation. Simple trusts are taxed like a person. Complex trusts are quite a bit different. This is a complex trust, and it has a discretionary clause in it. It gives the trustee unlimited power to transfer or hold assets in corpus. A non-grantor trust is when the grantor gives up trust assets and benefits when it's established. And we'll explain that a lot better when it comes to training. The trust is a separate entity with a tax ID number of its own. All transactions in this trust are done by notarized bill of sale. There's no gifting involved at all. It's all transferred by bill of sale at a cost basis to defer taxes. Again, there'll be a lot more training about this in the future. The 5 biggest benefits of this trust that we offer is asset invisibility. You can't see what's in the trust. Asset protection is all protected against IRS, against anyone suing your assets. You have complete control. There's a tremendous amount of tax benefits, and it gives you peace of mind because you actually control all of your assets. Now, assets in the trust transfer with 0 capital gains. Unlimited amounts can be sold. There's no limit to it. They're all non-taxable events. 0 capital gains on growth or sale of trust-owned assets. You can sell, buy, trade, whatever you like within these trusts, and there's no taxes due. There's no taxes due on your stocks and bonds when you sell it. Currency trading, and you see the list here, sale on any assets, real estate especially. There's no federal or state probate, and there's no gift taxes if you want to transfer it early. Now, grantor trust. This is the trust that most of us are familiar with, the revocable living trust. It's called a grantor trust. It has no tax protection. It has no asset protection. It goes under the simple tax code. We all file our taxes under the simple tax code. Well, most of us do. The only purpose for a revocable living trust is to eliminate probate. It's like doing probate ahead of time so your heirs get everything quickly when you pass away. Now, this is the most important aspect of a trust for us as funding agents. Funding a trust means you're going to transfer the assets to the name of the trust, away from the grantor. The trustee holds the trust property for the benefit of the beneficiaries. Whoever's named the beneficiaries will ultimately get the assets. The trustee controls it until it's transferred. Okay, a revocable living trust is funded by transferring assets in the form of a gift. Now, often a funding agent will transfer the real estate, all financial accounts, everything into the revocable living trust as a gift. The biggest problem with transferring as a gift is there's no stepped up basis. All right, the tax consequences are not going to change with a revocable living trust. Now, it's quite a bit different with the irrevocable trust. All right, they take on a different role. What happens is the grantor, also known as a trustor, the creator of the trust, they will initiate the trust and create the first transaction by funding the trust with $50 into the trust bank account. The grantor cannot be the trustee or a family member of the trustee. Once the transaction is complete, the grantor will submit a letter resigning to the successor trustee saying that they're no longer interested in participating in the trust and they'll step down. In that case, the successor trustee steps up to be the trustor. Now, at that point, they take over the trust and they do all transactions. Every transaction within this trust is done by notarized bill of sale and is done at cost basis. So there's no tax consequences in the future. Now, the commissions on these trusts are pretty good. It's 30%. So for instance, if you have a combination, the trust packages will run anywhere from like $7,500 to up to $30,000. If you have a complex business and you need one of our irrevocable trusts along with maybe a business trust, if you're going to do some complex transactions in the future. Some people have multiple trusts, but the way it works out is whoever sells the trust gets 30%. Then you have two levels before it. It's not multi-level, it's like agency levels. There's 5 and 5. And as you see here, if someone sold a combination package of 30,000, the person selling it, if you can equate it to this, the MGA would get $9,000. The GA, 1,500, agent, 1,500. So it's a pretty good payout. The next product is our flagship product. It's the one that a lot of agents that we have focus entirely on this product. They don't work with the trust, they work with premium financing. That's totally up to you what you want to work with. Now, it does not have any costly government regulations to implement because it's non-qualified. It does not have any tax ramifications. There's no taxes due on the money. There's no participation requirements. If you're a business owner and you have 20 employees, you do not have to allow them to participate like a 401k does. And there's no minimum required distributions. You don't have to start taking your money out at 59.5 or required at 70.5. You can take it out anytime you like. And when you take money out of this product, it comes out tax-free. What our program does allow, though, is allows certain tax deductions on the contributions, but you have to own a business to get the tax deduction. It allows tax-deferred growth. We're all familiar with that. Tax-free distributions, everything you take out is tax-free. Very large death benefit, and it includes living benefits, which we'll talk about. Living benefits, sometimes it's more important than a death benefit. Now, to qualify for this, it seems quite large, but this, you got to remember, we're going to be working with business owners. You have to have 5 million in combined assets if you're over the age of 51 and up. Okay, and your net worth is 2.5 million for ages 18 to 50. It's just the way they distinguish it. You have to be a business owner to qualify for the tax deduction, and you have to earn sufficient income that if it ever came to it, you would be able to pay the simple interest payments on the loan. Now, there's no collateral required as long as your net worth is over 2.5 million. And if you see up here, the minimum anyway is 2.5 million. The contributions by the bank, the minimum they will work with is $100,000 a year. They don't want to be putting anything less than that into a policy because it's not worth it to them. There's no maximum. If a client wants to put $1 million a year into their policy and they qualify financially and for health purposes, they can get it done. These contributions are made over a 7 to 10 year period. More often, it's a 10-year period. I'll give you a simple example of how it works, how our program goes up against a 401k. And there's a simple explanation here. This person here is 45 years old, they're standard, and they plan to retire at 65 like most people do. Some of us want to retire earlier, some don't care. Now, in a 401k, that person, that man, is putting $18,000 a year into it, and he gets a tax deduction for that. But there's no 18,000 in our program. Okay, and annual contribution by the bank, the 401k gets 0. Our person gets $100,000 a year. Expenses, 401k, say around $1,000 a year in expenses. There's no expenses in this non-qualified program. After 20 years, the client has contributed $360,000 into his 401k. With our program, he hasn't contributed anything. Now, after 10 years in the bank has contributed $1 million into his non-qualified program. After 20 years, with an increase in value of 7.1% compounding a year, and we use that because of over the last, say, 40 years, our market has averaged 7.1%. So that's the figure they used here. 20 years, it will grow to 771,000. But as you see here, we don't have a 401k account, so it's nothing. Now, at the same rate, 7.1, 10 years, 401k is zero. Our account is $1,486,000. Now, assuming taxation, because we all know you're going to have to pay taxes on this qualified funds, total. This is just a breakdown, a rough breakdown. The numbers aren't exact, but you can see what I'm talking about here. You're going to end up paying $270,000 in taxes when you draw your money out. So the actual 20-year value is about $500,000, and you can start drawing out at 65 at about $35,000 a year. That's net because you've already paid the taxes. That's included up here in the 270. But as you can see, our annual distribution is $104,072 tax-free. It's quite a bit of difference, almost 3 times as much there. So which would you prefer, 35,000 or 104? It's kind of a silly question, but sometimes you have to just ask people which would they prefer to make them answer it so they'll understand the difference. Now, this is just one presentation that I do. It's just a question that I ask occasionally. And I've done probably over 2,000 trusts in my life. So I know from experience that if you ask a question and you're sincere, people will answer it, no matter how personal it is. So don't be afraid to ask questions. And if they don't answer, just go to the next question. And you ask Mr. Jones, says, Mr. Jones, it's time to think about your assets and your trust and how we can magnify your retirement with tax-free income. If I were to set up a $10 million cash value life insurance policy that created tax-free income for your entire life, would you prefer to pay the $100,000 a year yourself, or would you prefer my bank to pay that annual premium for you? It's kind of a silly question, I know, but sometimes you have to ask silly questions to make a point. And based upon my experience with over 2,000 trusts, there's only about 2 ways they're going to answer this. The first one is right off the bat, I don't want life insurance. I don't need life insurance. I already have life insurance. Okay. The other way they're going to answer it is, how can your bank pay my premiums? Why would your bank pay my premiums? I've never heard of a bank paying life insurance premiums before. You have 2 different ways that they approach it. Now, this is how I answer it. Mr. Jones, after I ask that question, and he says, I don't want life insurance. I don't need life insurance. I already have life insurance. All I say is, okay. Then I just shut up and I start reading something in my lap, maybe a piece of paper, maybe some instructions. Take about 15, 20 seconds, maybe 30 seconds. Just remain quiet. Don't say anything. Let Mr. Jones say whatever he's going to say first. Most people cannot abide quiet time. They don't like quiet time, especially if they have a question in their head or an argument in their head. They just have to say it. So when Mr. Jones continues with this objection of his that he doesn't want life insurance, doesn't need life insurance, he's going to expound upon that. And when he does, slowly answer the question, and you'll find that it works a lot better. I have worked with hundreds and hundreds of agents funding these trusts, and more often than not, the agent will talk themselves out of the business by talking too much. When the sale is done, do the paperwork. You don't have to keep selling them, and always speak slowly. Now, that's a little bit easier for me because I'm from the South. Some people that I've worked with can't shut up. They're motor mouth. Remember, speak slowly. You don't have to tell them everything that you know. Okay, comes back to this one. The second question, Mr. Jones asked, how can you pay my bank my premiums? How can your bank pay my premiums? Why would your bank pay my premiums? I've never heard of this before. You hear that quite often too. And this is the way I justify it. I said, our bank's primary businesses premium financing of cash value life insurance policies with qualifying clients. They've already done $4 billion. They've paid $4 billion in premiums over the last 8 years. Now, they will place anywhere from $100,000 to $1 million a year in your policy, and they'll do it for 7 to 10 years. Just say in your case, it's $100,000 a year for 10 years. They're going to put $1 million into your account. Okay, that will accumulate tax deferred rather quickly. At the end of the 10 years, all right, if you want to, when you decide you want to start drawing your money out, they will take their $1 million back out, and whatever's left in that account is yours. And you got to remember, they've been paying the premium the whole time, and whatever's left in there is going to be yours. Then later on, or maybe that year, you decide you want to start withdrawing tax-free income. It doesn't have to be set up like an annuity. You don't have to do it every year. You can draw $100,000 out this year, skip next year, and draw $50,000 out the next year, and $150,000 a year after that. You determine how you want to take it out. There's no restrictions to it. As long as you don't lapse that policy and make it a modified endowment contract. Okay, so, but the bank takes care of that. They make sure that doesn't happen so you don't lose the tax benefits. Now, also, I always have to put this in this because I believe so heavily in this. Mr. Jones, as part of our process, the attorneys want to know if you have anything in place for business continuation in case you get a terminal illness, a chronic illness, a critical illness. Do you have enough money set aside, or would you have to sell your business in order to pay your medical bills? It's a good question because you're much more likely to get sick or hurt than you are to die. And that is terrible because I think last time I looked at it, more bankruptcies occur because of medical bills than anything else. So it's really important to have that covered. And this policy has it covered. All right. If you were to come up and they say, well, you're going to pass away in 6 months, 12 months, you can pull up to 75% of the face value, not what cash you have in there, the face value. If you have a $10 million policy, you can pull $7.5 million out tax-free to pay for your bills and to pay someone to take care of your business. Same thing with chronic illness. You can pull out $5 million tax-free. Critical illness, you could pull out $2.5 million tax-free. That covers any one of these things that might happen to you. Okay, so it's very important to you and your family that you have this on that policy, and it does have it. Now, the biggest thing for salespeople out there is how much these things pay in commission. Okay, imagine you have a policy and they're going to be paying $100,000 a year for 10 years. Based upon where IULs are paid in commission, if you sold one for $100,000 a year, you'd make about $60,000 on that up front. If you were the GA in this case, you'd make $5,000 override, and an agent make $5,000 override. But look at here, if your client decided to do $1 million a year, and there's no reason why he wouldn't, if he qualifies financially, do $1 million a year, your commission would be $600,000 for one sale. And if your agent sold that, you would make $50,000 off of that person. And here, another $50,000 for another level. So this is why some of our agents focus entirely on premium financing. The commissions are very large. They can be doing whatever they want to do. They can be selling businesses. They can be selling mortgage protection. They can be selling annuities, whatever they're selling. They'll be selling 1 or 2 of these a year. They're not trying to make this, a sale like this every month or every week. 1 or 2 a year puts you in a very good place financially. Now, corporate sales are incredible. I love corporate sales, and I'll explain a little bit why. Corporate sales will help eliminate capital gains when a business is being sold. Imagine there's all these outlets out there where you can find where businesses are being sold by their owners. I mean, you have Craigslist, you have Facebook, you have LoopNet, you have all these sources, Biz Buy Sale, where people are trying to sell their own business, and they're going to pay a tremendous amount of taxes, or they have to use a 1031 exchange. Now, corporate sales, what we do is we help them restructure their business for a profitable sale. This allows the owner to keep nearly all the capital gains that have accrued over the years. Now, I'm not saying they eliminate it, all right, because we can't ever say they're eliminated. At no time do we claim capital gains are eliminated. They're always delayed and deferred indefinitely. And doing it this way, when you make the sale without having to do a 1031 exchange, you don't have that limitation on time, 90 to 180 days to reinvest in a like-kind product or like-kind property, I'm sorry. What we do is you put your money into the bank account after the sale and you take your time finding another business. Or if you decide you want to get out of the gas station business and you want to put your money into cryptocurrency, you can do that without any tax consequences. Now, continuing with this, let's just say John started his business about 20 years ago and he put $100,000 into it. And over the 20 years, the CPA has had him depreciate his business, his equipment, everything that can be depreciated. So his cost basis when he goes to sell is practically zero. Okay, now using a 20% capital gains rate, say he sold the business for $5 million. That would be approximately $1 million in taxes due if he doesn't use a 1031 exchange. And we just talked about a 1031. They're great. They will defer taxes. You have to put it in a like-kind property. But why not invest what you want when you want instead of being forced to invest and make a quick sale? So our CPA works with John's CPA. And they saved John 90% of that amount, the $1 million, using our trust along with a deferred business trust. Because there's all kind of trusts out there. They all have this separate purpose. We also do a deferred business trust that helps with this. So instead of $1 million, John now owes the IRS only $100,000 in capital gains. We just saved John $900,000. Provided he doesn't use a 1031. Because again, if he uses a 1031 exchange with a like-kind property, he can defer those taxes. We just do it a different way. For this, we provide all the trust documents and all the legal at no cost. Now, when John sells his property and he comes out with that $900,000 we were just talking about, more than he would have received, he owes us, our company, 30% of that amount, which is $300,000 approximately. Okay, again, it's about what he owes. So again, right here, I have my numbers wrong. It's actually going to be $270,000. I'll correct that, but for your purposes, it's $270,000, 30% of the $900,000. So then we get 30% of the $270,000, which would be whatever it comes out to be, 80. Let's see, 27. What, $84,000. That would be our commission, about $84,000, which is not bad because all you're doing is getting the information that John wanted to sell his business and he's interested in saving money on his taxes and just turn it over to the corporate division. They'll make the sale for you. They'll do all the paperwork. They'll do all the legal, and you make your commission. In this case, $80-something thousand, which is not bad. Now, the next division that we have, because we have realtors on our staff, is business sales. Now, that is very lucrative in itself because you can help the business, the realtors, by finding the businesses. Again, for sale by owners work out real well. They don't want to pay broker fees. And with our business, the way we have it set up with the corporate, you don't have to pay broker fees because we have the buyers ourselves. Nexus and our realtors have a whole list of buyers that want to buy businesses. So it works rather quickly. They sell the business to our buyers, we make our fees, and everybody's happy. Now, business division. What you do is you locate businesses. Just like I said earlier, you just locate people that are for sale by owner that wants to sell their business. We don't want businesses that's selling for $50,000 or $100,000. It sounds like a lot, but it's not really worth anybody's time. You want businesses that have been around for a while, that are, 10, 20 years, 30 years in business, They've accumulated a lot of equity, so there's going to be a lot of a lot of capital gains taxes. And you just turn it over to our realtors and you turn it over to Nexus. Like I said before, we have buyers already set up to purchase these companies, so you don't have to list it. They'll save that listing fee of about, some people charge as little as 3%. I've seen some as high as 10%. So John would have had to pay $500,000 in broker fees if he didn't work with us. Now, you receive a portion of that as a referral fee. In this case, in John's business, $5 million sale, you would receive about $50,000. Now, this number right here, if you add the two up, I calculated it before, it was 140,000. Actually, now I have to readjust the numbers. It'd probably be closer to about 135,000, but that's still a good number, isn't it? You're still going to make a lot of money off of one sale, and all you did was turn it over to the right people. Now, that's all we have for today. I know it's short, but I just wanted to give you an overview of what we do and how we do it. Now, this is my email address, briancausey@nexus.com. If you have any questions, that's where you want to go. You want to ask me the questions. Now, in order to qualify to work with the company, you have to listen to our CEO, Scott McGrath. Okay. Every Monday at 3 o'clock Central, 4 p.m. Eastern, he gives a little presentation to new agents. He wants to make sure you're aware of everything that we do, make sure that I didn't say anything wrong. So you have to attend on Mondays. Now, if you plan to attend, just email me and let me know that you plan to attend. This is the link right here, the zoomroomlink.com. Copy that down, HTTP, zoomlink.com, and go there Monday at the appropriate time, whether it's Central, whether it's West Coast, the East Coast, it's 3 p.m. Central, 4 p.m. Eastern. After the meeting, okay, if you decide you want to continue, okay, you go to newwaytoown.org, contract. You'll find all the paperwork there that you need. You just download each one, you fill them out, scan them back in, and send it to my email address, briancausey@nexus.com. That's all you have to do. If you have any questions, which a lot of people do, email me. If I have to call you to answer it, make sure when you email me, you put your telephone number, because sometimes the answers are so long and so detailed that it's better if I just call you. So make sure you put your name and your telephone number when you go to briancausey@nexus.com with your questions. Ask as many questions as you like. You can ask questions about the trust, about premium financing, corporate sales, or business sales. We have other products, but those are the four we're focusing on. Those are the biggest commissions, and they work very quickly. Now, that'll be all for today. Thank you for attending. Goodbye.